Imagine this for a second. You open your screen and see silver trading at around $92 on paper. Sounds normal, right? Just another number flashing on a chart, moving up and down like it always does. But then you talk to a physical dealer, or you check what real buyers are paying in Asia, or you look at delivery premiums, and suddenly the number isn't 92 anymore. It's closer to $118. Same metal, same silver, two completely different prices. So, the question becomes simple, and honestly, a little uncomfortable. If silver is really $92, why are people willingly paying $118? And if people are paying $118 without hesitation, then what exactly is that $92 price showing us? Is it reality, or is it something else entirely? Stay with me, because once you truly understand how this works, you'll never look at silver prices the same way again. Before we go any further, if you like market stories that actually explain what's happening behind the numbers, not just what the numbers say on a screen, make sure you hit like and subscribe. On Market Analysis, we focus on what's happening beneath the surface of the financial system, where the real stories live. Your support helps the channel grow, and it tells me you want more deep dives like this one. Now let's slow this down, because this topic deserves patience. Most people believe there is one silver price, one global number, one shared truth. But that belief is outdated. It comes from a time when paper and physical markets moved in lockstep. That world doesn't really exist anymore. What you usually see on financial news, trading apps or market tickers is the paper price of silver. This price is discovered mainly on large exchanges like COMEX in the United States and the LBMA in London. These are paper-based markets. Futures contracts, options, swaps, promises, claims, most of the silver traded. There never moves, never gets delivered, and never leaves a vault. In many cases, it never even exists in physical form at that moment. It exists as an agreement. On the other side of the world, especially in Asia, silver trades very differently. In places like Shanghai, the market is far more focused on physical settlement. When silver trades there, metal actually changes hands. Bars move, inventory matters, delivery matters, and this difference in structure is where the disconnect begins. For a long time, these two worlds stayed close enough that hardly anyone questioned them. Paper and physical prices moved together, with only small gaps that quickly closed. Arbitrage kept things in line. Confidence held the system together. But something has changed. That connection is weakening. The gap between paper silver and physical silver is growing, and it's not happening by accident. It's not noise, it's a signal. Think of paper silver like a boarding pass. As long as the plane isn't full, nobody worries. Everyone assumes they'll get a seat. But when the plane fills up and suddenly every passenger wants to board at once, the boarding pass alone doesn't guarantee anything. A physical seat becomes more valuable than the piece of paper. In the silver market, paper contracts have exploded in size. There are far more claims on silver than there is actual silver available for delivery. Under normal conditions, this doesn't cause problems because most traders never ask for metal. They trade contracts, close positions, roll futures forward, and settle in cash. The system works as long as confidence remains high. But conditions are no longer normal. Industrial demand for silver is rising rapidly. Solar panels require silver. Electric vehicles use silver. Data centers, medical equipment, advanced electronics, and military technology all depend on silver. This is not optional demand, it's structural. At the same time, silver mining supply is not growing at the same pace. New mines take years to develop. Existing mines are facing declining ore grades, higher energy costs, labor issues, and geopolitical risks. Physical silver is becoming tighter. Now add another layer. Inflation fears, currency debasement, rising debt levels, geopolitical tension, growing distrust in financial systems. When people lose faith in paper assets, they turn toward hard assets. Gold gets attention, but silver has a unique position. It's cheaper, it's more accessible, and it's both an industrial metal and a monetary metal. That combination makes it especially sensitive when systems start to strain. So what happens when more people want physical silver, but the market is built primarily on paper promises? Pressure builds. Quietly at first, and then visibly. That pressure shows up as premiums, shortages, and delivery delays. And eventually, it shows up as a widening price gap. Let's talk specifically about Shanghai versus COMEX. In Shanghai, premiums on physical silver have been rising. Buyers are willing to pay more to secure real metal now, not later. That premium reflects immediate demand and real supply constraints. In COMEX, the price still reflects a paper market where contracts can be offset, rolled, or settled in cash without metal ever leaving storage. This doesn't mean COMEX prices are fake in the sense that they're imaginary. It means they represent something different. They represent confidence. Confidence that contracts can be honored. Confidence that delivery won't be demanded by too many participants at once. Confidence that paper claims will remain acceptable substitutes for physical metal. Physical prices represent something else. They represent reality when delivery matters, when timing matters, when possession matters. Here's where things become very important. When the gap between paper and physical stays small, the system looks stable. When that gap grows and stays wide, it tells us that physical buyers don't fully trust the paper price anymore. They're saying, that number on the screen doesn't guarantee metal. So I'll pay more to make sure I actually have it. We've seen this pattern before. In energy markets during shortages, in food markets during supply shocks, even in currency markets when people rush into physical cash or foreign assets. Whenever physical supply tightens and paper markets remain large, price discovery starts to break. People call this manipulation. Others call it distortion. Others call it leverage gone too far. The label isn't as important as the outcome, and the outcome is clear. There are now two silver markets. One is fast, liquid, and mostly virtual. The other is slower, tighter, and very real. For investors, this creates confusion. Someone looking only at charts might think silver is calm, cheap, or even boring. But someone watching physical flows, inventory reports, and premiums sees tension building quietly beneath the surface. This is why stories about silver shortages appear, disappear, and then reappear. On paper, there's always enough silver. In reality, delivery times extend, premiums rise. Certain bars, coins, and products become difficult to source. The system doesn't collapse, it stretches. Ask yourself this: if paper silver truly reflected supply and demand, why would physical buyers consistently pay more? In an efficient market, arbitrage should close that gap. Traders should buy cheap paper silver, take delivery, and sell it where prices are higher. But that arbitrage is getting harder. Delivery requirements are stricter. Costs are higher. Available metal is limited. Time delays matter. These frictions are not accidents, they're symptoms. Now imagine what happens if institutional investors decide they want physical exposure, not just paper hedges. Or if industrial users decide they need guaranteed long-term supply. Or if retail investors lose confidence in financial markets and want something tangible. Each of these increases pressure. Together, they could force a major shift. A reset doesn't have to be dramatic. It doesn't need a single explosive moment. It can happen slowly. Premiums creep higher. Inventories decline. Delivery becomes selective. And then, quietly, the paper price starts chasing the physical price instead of leading it. This is why experienced market watchers don't judge silver as cheap or expensive based only on the dollar price. They look at availability. Look at trust. They look at how hard it is to actually get metal when you want it. Price is only the visible layer. Structure is everything. On market analysis, we focus on these hidden layers because that's where future moves are born. Big price changes don't come from headlines. They come from imbalances that build quietly while most people aren't paying attention. If you're still watching, you're already ahead of the crowd. Most people stop at the chart. They never ask what that price really represents. So, is the silver price fake? Not exactly. It's incomplete. It reflects a system built on leverage, liquidity, and confidence. Physical silver prices reflect scarcity, immediacy, and reality. When those two drift apart, it tells a powerful story about stress in the system. Going forward, watch the gap. Watch Shanghai premiums. Watch inventory levels. Watch delivery data. Watch how often buyers choose certainty over price. Those signals matter more than daily price swings. Near the end of this video, I want you to think about one simple question and answer it in the comments. If you had to choose between silver at $92 on paper or silver at $118 in your hand, which one would you trust more, and why? Your answer helps everyone understand how real people are thinking about this market. If this breakdown helped you see silver differently, share it with someone who still believes every price on a screen tells the full story. These conversations matter, and they shape how prepared people are for what comes next. Thanks for watching, thanks for supporting Market Analysis. And I'll see you in the next deep dive, where we keep pulling back the curtain on how these markets really work.